March came in like a lion. Hey, this is Dave with the Bolduc Realty Group. Welcome to my weekly real estate market update. Today's March 24th. Quite a few things going on that are impacting the Connecticut real estate market. We'll jump into that. Before we do, please like, subscribe, ring the notification bell. I like to put the information out so everybody knows what's going on out there. And also, comments are always welcome. I really enjoy getting feedback on what I'm saying, what you agree with, disagree with, and any questions you may have. Talking about the key Connecticut market stats. So we have 3,435 houses active on the market, down 20 from 3,055. So inventory is a little flat. We have been seeing a good number of houses come on with new listings. They're just going under contract really quick. So I expect to see those number of active houses creep up over the next few months here. Remember, inventory is seasonal. Low in the winter, high in the summer. We're going into the spring market, so we do expect to see more houses come on, and we will see the number of houses active continue to creep up. That is completely normal. It's not an indication right now of a weakening market. As a matter of fact, multiple offer, over asking deals for nicer houses are still happening. Even for not so nice houses. I was up in East Hartford yesterday with an investor looking at a property that needs to be flipped. And it's about $200,000. They wanted to make an offer. Called the agent, says, "Oh, we already called for highest and best. Send me your offer quickly." We went in above asking. There were dozens of offers, and we didn't get it. So there's still a lot of buyers out there. We'll keep an eye on that as we go. 2,100 houses were closed in February. We're already over 1,900 in March, and we've got 6 business days left, including today. So I do expect us to get over that 2,100 for March, which is, again, closings are seasonal, more in the summer, less in the winter. So as we go into spring, we should see those go up. About a month and a half of inventory, so we're still in extreme low inventory position. So there's some key dates here. Some positive news in general during the month of March towards the middle and end of the month. The CPI came in, which is retail inflation, as expected. PPI, which is wholesale inflation, came in lower than expected. Double thumbs up there. And consumer spending was in line. Some not so good things from a real estate and mortgage perspective. The jobs report was stronger than expected. I've talked about that before. You can check my other videos as to why it's not a good thing. And then banking scare certainly has the market on the edge. So the Fed increased the Fed funds rate by 1/4 of a point. This is what was expected. Some people are saying it's too much. Other people saying it's not enough. So that tells me it probably is about right. There is risk related to the continued increases in interest rates, and that's bond yields. So bond yield is the interest paid to bond holders, and it tends to go up as the Fed funds rate goes up. This means that newly issued bonds have a higher yield or interest rate than older existing bonds do. That means the existing bonds that earn less are perceived as being worth less. And so banks that buy bonds to earn interest on deposits that aren't loaned out, if too many depositors come in and say, "Hey, we want our money at the same time," the banks are going to have to sell those older bonds that have lower yields and are therefore worth less, and they're going to take a loss. This is basically what happened with the Silicon Valley Bank. A lot more detail is in there, but just very high level, basically what happened. So I've seen numbers as high as 150 other banks that are at some level of risk, I'm sure on a spectrum. Make sure you know how FDIC, which is a Federal Deposit Insurance Corporation, how that insurance works. Talk to a banker or a financial advisor if you need some advice on that. As of today, there are a grand total of 2 banks that have failed. This is according to the FDIC website. So that's the Silicon Valley Bank on March 10th and Signature Bank on March 12th. Yes, there are other banks at risk. Yes, there is concern. Educate yourself, protect yourself, and then you got to move on. So primary mortgage market survey, we're at 6.42 versus 6.6 last week. Mortgage rates were creeping up with the strong jobs report and the banking failures. With the good news in the inflation report, consumer spending, and also the Fed decision to only go up 1/4 of a point, which is what was expected. And believe me, markets love when things happen as expected. The interest rates have softened up a little bit. Additionally, Chairman Powell from the Fed indicated that it may be time to stop raising interest rates. This is a change from previous talking points, and bodes well for mortgage rates going down in the future here. So that's how March came in like a lion and seems to be going out like a lamb. Let's hope for the best. That's all I have for today. Any comments, questions, throw them in the comment section down below. Have a great weekend.